Hey soldiers, has the recession been canceled? We're seeing several high-placed Fed officials, Federal Reserve Bank officials say, hey, there's no need to keep raising rates. They're looking at something called the Financial Conditions Index, or indicator rather, that leads them to this belief. We'll get into that. But look, here's how it works, and this is what I've said to you time and time again. I think the Fed is going to sacrifice us on the altar of high inflation. At least initially, they're going to bring those rates down after, a period of not raising them any further. And when that happens, we are going to see a bout of increased inflation over and above what we're already seeing. Now, they're saying that inflation is at 3.67%, and that's total BS. We did the video, the one that we did before this one shows you exactly what we are experiencing, even at discount wholesale stores like Costco. Look, guys, butter is up 43%. Okay, so don't give me this 3.67% nonsense. We're looking at an environment where, again, we're going to be sacrificed on the altar of high inflation and maybe even creeping hyperinflation, where we get up one morning a year from now and butter is a full 110% more. Think it's impossible? Look at that video we did just yesterday. Flour is up just over 100%, and mayonnaise is up 107%. So it's possible. Those are hyperinflationary numbers right there. So if we're living in these times and thinking that we're not going to be touched by, you hear all these pundits talking about, we're in hyperinflation. That's something for Zimbabwe, Weimar Republic. We're not in danger of that. We're living it. All right? We're living it based on the demonstration of prices, again, at wholesale clubs that are supposed to be, where you can get the best buy. So when you look at a per unit price of mayonnaise, for example, you're probably well over 100%. Okay, maybe into the 125, 150% range. But we've got two Fed presidents who are saying that, look, we think we can stop with these interest rates hikes. So, while we might not go into a recession because of that, remember, we're going to be faced with a situation where now we've got folks who are responsible for paying back these student loans. We got over $1.7 trillion in student loan debt in this country. We've got over $1 trillion in credit card debt in this country. Delinquencies are rising. The consumer is feeling the brunt. So we might see spending slow down independent of rate increases. And the Fed knows this. Goldman Sachs trader Cosimo Kodashi Pizzanelli explained, the primary argument that can be made for the Fed not hiking again this year is that the FCI, the Financial Conditions Index, is tightening enough and replaces the need for hikes. So again, we're seeing those conditions just organically occur in the households of average Americans where they can't keep spending, all right? Especially when, again, those credit card delinquency rates are spiking. People are having trouble. And if they're not having trouble, they're reaching the limit of their credit. Okay, so they can't spend as much anymore. Indeed, as shown in the chart that we'll put up here, the FCIs have tightened materially over the last few weeks as the long end rate sell-off has begun to impact risk assets and the U.S. dollar has rallied. Now, let's go to the Fed officials who are talking further about this. This means that thanks to the magic of market reflexivity, we are seeing much more effective monetary policy transmission than when the Fed hiked aggressively in 2021, when the aggressive curve flattening limited the FCI tightening. So basically, that's a whole lot of mystical speak for, look, the garden variety conditions of what the U.S. consumer is going through right now is having the same, if not a greater effect than raising the interest rates at slowing the economy. Mary Daly, who is a Fed official based in San Francisco, said, If we continue to see a cooling labor market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. Remember, guys, there are two policies that control the economy or are heavily involved in the economy of the United States of America. That's monetary policy, which is set by the Fed in the form of interest rate manipulation and a money supply. And then there is fiscal policy, which is controlled by the Congress and the president in the form most usually of taxation, okay, either lowering it or increasing it. So Mary Daly is saying, look, she agrees with Cosimo over at the Goldman Sachs Bank that, things are occurring to slow down the economy independent of those, independent of monetary policy. So she goes on to say, likewise, if financial conditions, which have tightened considerably in the last 90 days, remain tight, the need for us to take further action is diminished, us being the Fed, right? And their monetary policy actions. Dallas Fed President Logan said, thus, if term premiums rise, they could do some of the work of cooling the economy for us, leaving less need for additional monetary policy tightening. So as you can see, there's a growing consensus within the Fed itself that we're done raising rates. Oh, rejoice, we're done raising rates. So that will mean that sectors like real estate will notice a leveling off of the price of money it takes to get a mortgage, okay? That's not saying that the price of homes will decrease, but I will say that the amount of home you get is probably going to be a whole lot less than it would have been just 3 years ago. So we may see interest rates decreasing, but at the same time, if we see policies like our energy policy continue along the lines that it has, and we do see constraints coming out of OPEC. We got this situation in the Middle East now that probably will also, has actually driven the price of oil up. Everything we produce, everything we transport will have a corresponding price increase, and we are going to see that. So it's not like you're going to say, hey, I got to put that boat purchase off. I was going to get me a brand new Bayliner, but it's just not in the cards right now. You can't do that with butter. Okay, you can't do that with flour, with bread, all right, with juice for the kids, meat for the family, all right? So even though you can cut back on discretionary, look, guys, we've seen it. I told you in the previous video that we will link to here. These prices are absolutely in the hyperinflationary area right now. All right, guys, I'll talk to you soon.